how trading has changed with the advent of automated trading, how everything has become computerized, and because everything has become computerized, how risk management takes a whole new meaning these days. Okay. So the way the session is structured today, first we will look at the changing trends in trading. Then we would look at some of the major risk failures that have happened. So this is going to be an interesting session, seeing how and why firms lost money the way they lost money, and how it could be very catastrophic in very quick time. Okay, I see some questions already. Okay. Okay. Yeah. So, you know, having seen some of those failures that some of those people did, then what we would do is we would actually look at what are the risk management practices and then policies that firms should implement for doing risk management in case of automated trading. Now, and then eventually we would look at some of the regulatory requirements from the perspective of risk management. Okay, so let us start with changing trends in trading. So what has happened lately? It's a byproduct of what people felt as a necessity. If assume you have a profitable strategy, trading strategy, then what would you do? You'd want to do it as much as possible. You'd want to trade it on as many instruments as possible. You would want to do it as long as possible, not have any downtime. You would also not want emotions like greed and fear to affect your profitability. You would want it to be as structured and objective as possible without letting any subjectivity to creep in. Now, if you want to do it that way, what do? You could, if you use a computer, it would do it. It would help you scale it up, because computers don't take toilet breaks. They don't take lunch breaks. A human eye can probably monitor 10 or 15 stocks at the same time. Computers can track thousands of instruments at the same time. So if you want to do trading, if you have a profitable trading strategy, then the best way to scale it up is by doing it algorithmically. That is using computer models to trade it. Now, therefore, because it's usually profitable for the traders to trade it automatically, so a lot of traders started automating their trading strategies, and inevitably machines have started taking over human beings. So traditionally trading used to be in the pits. Now it has changed to computers, and even more computers. And because money makes the world go round, if you see something being more profitable than a traditional way, then you would obviously adopt it. And because everyone has been adopting automated trading, and then you get to trade more when you're doing it in an algorithmic fashion, it has, you could see it in the kind of volumes and then the growth of various asset classes. So basically, algorithmic trading has become hugely popular everywhere. But computers can only think what they are taught to think. They cannot think outside their boundaries. They can only think what they have been programmed to think. They cannot think outside those limits, what they were programmed to do. So therefore, if you do not think of all eventualities when building your system, you would miss some of those. Your system will not respond properly. And therefore, while it is more profitable because of the following factors that we have mentioned, it is often hugely risky. Why is that so? Because one, the traditional systems, the traditional trading systems were fairly simplified and then fairly simplified. But now, with automated trading, this architecture has become hugely complicated. So in fact, in our detailed online program on algorithmic trading, we would be looking at this structure the components of an automated trading system in huge detail, wherein we would be looking at how each of those blocks that we see in the diagram interact with each other, how a market data block would interact with the CEP block, how the CEP block would interact with the order management block, and so on. So what we can see is that the number of processes has gone up drastically, the connectivities has gone up drastically, so therefore the whole system has become hugely risky. So at the very beginning of the presentation, to make this thing a little fun, let us look at certain case studies, certain incidents that have happened, and some of these are very interesting stories, some not so much. So the first incident, I've tried to put it in chronological fashion. The first incident happened in November 2007. So Credit Suisse, what did they do? They sent hundreds of thousands of cancel orders to the exchange. And then these orders clogged the exchange and then affected trading in 975 stocks. So the exchange actually had to stop trading in those stocks. And then they couldn't handle such a huge volume of orders sent by Credit Suisse. Now, at the end of the day, the firm was fined $150,000, which is a small amount given the kind. As we go ahead, we will see the kind of losses some of the other firms have made and so on. So it looks like a small amount in that context. So what actually went wrong? We know that they sent hundreds of thousands of cancel orders, and this actually clogged down the exchange. The exchange couldn't respond. But then what went wrong? It was basically a software engineer at Credit Suisse. What he did was he thought he would change the design of the system slightly. So what he did was, there is this user interface component known as spin button. So within a spin button, if you click on the upper button, the value changes by 1. If you click on the lower button, the value changes by 1. Now, earlier the design was such that after you click on either the upper or the lower button, you had to click on a confirm button to set the parameter. Now what the software engineer did, he thought that let me remove this confirmation button so that it will be easier for the trader to set parameters. So he removed the concept of the confirm button. Now because he removed the concept of the confirm button, the very next day when the trader started trading using that interface, he clicked on this upper arrow 3 times in a row by mistake. So because he clicked on it 3 times in a row by mistake, first the trading strategy parameter got set to the first increment, then immediately it got set to the second increment, and then immediately after that it got set to the third value. So within a very quick span of a second, a few microseconds, the value changed from 1 to the next to the third. So the value changed so frequently, so the all trading strategy, the orders which were supposed to be calculated on the basis of this trading strategy parameters changed very quickly to 3 sets of values. The first set of value, and then you have to send out a whole lot of cancel orders for the values which you had sent out for the first set of orders, and then the eventual value which got set here was hugely incorrect. Because it was hugely incorrect, a huge number of orders went out, and then basically the system lacked a cancel button, confirmation button, because the trader didn't have to confirm. So an incorrect value got set here, and then a huge number of orders went out. So it's very easy to just click on this up or down arrow, and then the trader clicked on it 3 times in a row instead of clicking it on it only for once, and then a lot of wrong parameter value got set. So it seems very simple, but just not having a confirm button meant that 975 stocks on the exchange didn't get traded in the last 10 minutes. And the firm lost $150,000, which is not bad when you look at the $850,000 lost by Infinium Capital. Infinium Capital is a firm based in Chicago. They were one of the pioneers in the usage of advanced technologies for high frequency trading and so on. So I've met quite a few of their initial founding team when I was in Chicago 2 months back, and they use quite revolutionary techniques and technologies at their time. But even a firm of that stature, they also sometimes fail to look at certain basic stuff like this. They had designed a trading system which was supposed to trade energy ETFs on the basis of crude prices. The system was doing good, the trader was making good money, and then he got greedy. He thought, okay, it works well when I trade ETFs on the basis of crude, let me try it the other way around. Because he tried it the other way around, he was now trying to trade crude on the basis of ETFs. Now the ETFs are not as liquid as the main crude oil future. Therefore, when he tried to trade on crude on the basis of an illiquid instrument, the price that was generated for quoting in crude was usually incorrect. The ETF market is illiquid, and then if you are using an illiquid market to determine what is the fair price that should be quoted in the crude market, so basically the ETF market was off and then was illiquid, and then they were using the mid to determine the mid of the ETF market to determine the fair price of the crude oil market and then trade in crude oil. And ETF was one of the two sides, the bid or the ask, one of the two sides got illiquid, and they sent a huge number of orders in crude oil because if you do something wrong in the financial markets, everyone is waiting for you to make mistakes, and then everyone will pounce on you and then exploit you. If you have to compete with everyone to make profits, but then if you do something wrong, everyone who is competing in the markets will exploit you. And then that is what happened. They did 4,000 trades in 24 seconds, which is not a lot of trades to be done in that time frame. In fact, you could potentially do if few multiples more than the 4,000 if your parameters are off. In fact, the system was designed to trade crude, and therefore the risk management was designed to trade on ETFs, and then therefore the risk management was also designed from the perspective of trading on ETFs. So when the trader started trading crude instead, even the risk management system was not configured to work on it. A very similar incident, again another big bank, and this time it was even more tragic. They had to close down their quant or AQT, the automated quant trading desk in Tokyo. What happened in case of Deutsche Bank? They had a system wherein you could trade Nikkei on the basis of the prices of the Nikkei ETFs in Singapore. So Nikkei ETF in Singapore and Nikkei and mini Nikkei, so they were trading all these three instruments together because at the end of the day the underlying is the same. So the underlying is the same, so you could trade Nikkei versus mini Nikkei versus Nikkei ETFs, which is in Singapore. So one day they had a change in their trading system configuration. And because there was a change in the configuration file, the way it was, the architecture was changed, the very next day, somehow the system couldn't read the prices of the Nikkei ETF trading in Singapore. Because the system couldn't read the prices of Nikkei ETFs trading in Singapore, it saw the price as zero. Because it saw the price as zero, it said that the fair price of Nikkei is zero. So in Japan, I'm going to trade Nikkei at zero. So they say that, okay, if the fair price is zero, I'm going to add an offset and then try to sell it slightly above zero. So they tried to sell Nikkei at slightly above zero in Japan because they read the price of Nikkei in Singapore as zero. The reason they read the price of Nikkei as zero in Singapore was because of a configuration change, and because of which they were trying to send orders to sell Nikkei slightly above zero, and then obviously the Nikkei was not priced at zero, and then they sent out orders for 1.24 million futures. The market dropped 1%, even though they recognized the error immediately. And only 0.3% of the orders got executed, yet the market dropped 1%, more than 10 times normal volume, and so on. Another case study. This is the most popular case study that a lot of us might have heard. The incident of Knight Capital. What happened in case of Knight Capital? They traded 154 stocks at bizarre prices, 4 million trades in 45 minutes at hugely incorrect prices. They lost 460 million in 45 minutes, and on top of that they had a fine of $12 million, which looks small in comparison to the trading loss. So what went wrong in case of Knight Capital? In case of Knight Capital, they were trading, the software team designed an enhancement to the system. The enhancement to the system, what it did was, it required two modules. So the software enhancement required two modules, Module A and Module B. For the software enhancement to work, you had to install Module A and Module B in your trading servers. Now they had 8 trading servers trading that strategy. Out of those 8 trading servers, in 7 of those servers, Module A and Module B, both of them were installed properly. In the 8th server, they only installed Module A. Now Module A requires Module B to work fine. Now because they didn't install Module B, but then coincidentally, there was another library with the same name, Module B, which was designed 9 years ago. So Module A was referencing some another totally unrelated piece of code which has the same name and which was designed 9 years ago. So just because one out of the 2 modules was not installed on one out of the 8 production servers, Knight Capital lost $460 million in 45 minutes. So what was the problem here? One prime issue here was the fact that there was just one person from the technology team who was installing the software, who was making those infrastructure configuration changes and so on. So Module A and Module B had to be installed in all the servers. So one person was doing it. He just did it on 7 servers properly. On the 8th server, he just copied one of the files and not both of the files. And there was no one reviewing it, or there was no automated system saying that, okay, for how do I ensure that the installation went proper and so on and so forth. So because they lacked such a system, so therefore what happened was one of the servers, the code was totally incorrect, and that's it. They had to be bought by get-go, and then to save on taxes and so on, so they termed it as a reverse merger, and then so now the firm is known as Knight Capital get-go. We talked about Credit Suisse, we talked about Infinium, we talked about Deutsche Bank, we talked about Knight Capital. Another big boy, Goldman Sachs, they were not immune. So what happened in case of Goldman Sachs? In case of Goldman Sachs, they actually traded stock options at hugely erroneous prices. Why was that so? In certain exchanges globally, you could actually send indications of interest. You could send requests for quotes. So basically, these are for if you want to trade a new instrument, which is composed of a combination of the existing instruments. So you could ask other market participants for quotes in that instrument. So you could ask other market participants for a quote on the combination of some of those instruments that already exist. So it could be a set of option instruments and so on. So instead of sending a request for quote or an indication of interest, they send them as actual orders to the exchange. And then what happened after that? They made a trading loss of 100 million. Not a big incident. The shares, basically someone entered the name of the firm incorrectly, and then so the stock price of Israeli Corp, which was trading at 1,6,700 shekels, they typed in the name of another firm which was trading it around lower hundreds or something of that sort, and then therefore the stock price dropped down drastically. Another interesting incident from China. This is interesting because of two factors. One, there was this brokerage house called Everbright Securities. It's one of the bigger. It was one of the bigger brokerage houses, and they have had their own proprietary trading division as well. So within their proprietary trading arm, they were trading trading the markets, and then one of their algorithm went wrong. So one of the algorithm went wrong, so it just kept buying the index. It just kept buying and buying and buying, and then the index went up 6% because of that. Then they realized that there was a fault in their algorithm. Because when they realized there was a fault in their algorithm, they just started selling the artificial bubble and then tried to get rid of their position. And this is the thing that I don't understand actually. The regulators said that you realize that the bubble was artificial, and then which you shorted, and then they have been banned because of insider trading, not because of the fact that an error in the algorithm just kept buying and buying and buying, but then they have been banned from trading on their own books forever because of insider trading. This is another very interesting incident which happened in Korea in December 2013. So there is this firm known as HanMag Securities. So in their case, once again, they had a change in their configuration files. So because of a change in their configuration files, what happened was one day, the calls and the puts, the calls were recognized as puts in the system, and then the puts got recognized as calls in the system. So an out of the money put, so if the underlying is trading at 1,000, then a put with a strike price of 800 would be an out of the money put. But then the call with the same strike price would be an in the money call. 800 call will be an in the money call. So an out of the money option obviously is priced very lowly. It's very cheap. But then the in the money option would have a huge, should be priced heavily. It should have a, it should be priced well. So if you interchange your calls as puts, now you would see that the price of out of the money instruments, which are very cheap in the market, you would read them as in the money options being very cheap. So you would see that in the money options are trading very cheap in the market, but then those in the money options are actually out of the money options. So basically, if you read the prices incorrectly, you are going to make wrong decisions. So the out of the money puts were being read as in the money calls, and then the system saw that the in the money calls were cheap, so it exercised all those American option calls. Likewise, out of the money calls were read as in the money puts, and then they saw that the price of in the money puts were hugely cheap. That was cheap because they were actually in reality out of the money calls, and because of a fault in the configuration of the system, so it was being read as in the money puts, and then therefore they failed that the system failed that the in the money puts were trading very cheap, and then therefore it traded them and then exercised them straight away. Now when it, so it did 36,000 trades in a few minutes, and how much did it lose? 57 billion Korean won. In fact, the net worth of the firm was only around 3 or 4, probably 5 billion Korean won, if I remember correctly. So the firm, if I remember correctly, went bankrupt because they couldn't make back the losses that they did because of one configuration error. That's it. There is another interesting field within automated trading. It's a concept known as automated news trading. So what happens in case of automated news trading? So there are various news reports that keep coming on various news wires. Now, instead of a human being reading through the entire news article, if a computer system can scan through the news article and then predict and then gauge whether the news article has something negative or positive to say about a particular firm, then the computer system would be able to do it without human intervention. Such a system would be able to look at way higher number of news articles. It would be able to respond very quickly to news events. So the moment a news event happens, the computer system which is scanning through news articles would be able to respond straight away, instead of a human being having to read through the entire article and then trade on it. So, so automated news analytics-based trading is basically the concept of computer systems reading news articles and then trading on the basis of the quantified scores formed by text analytics, text analysis of news articles automatically. So basically, this computer text analysis programs, what they do is, for each news article, they will generate some sort of sentiment score, some sort of relevance score, some sort of novelty score, and so on. So, and the market impact score, and so on. So it would generate various quantitative scores for each and every news article, and then your trading system on the basis of those quantitative scores would trade on it. That is well and good, but what if you feed it wrong news articles? If you feed a wrong news article to the system has no way to determine if it's a wrong news article or a right news article. So it's just going to generate the quantitative scores, and then your trading system will trade on it. Now, one day, Google's news bots picked up an old news article and then published it as new. The moment they published it as new, what happened after that? All automated news analysis-based trading systems which saw that news article saw it as a negative news article about United Airlines. Because they saw it as a negative news article, a news article with a negative impact for United Airlines, they sold the stock. Therefore, the stock had a negative down spike immediately at the moment of the news, which goes to show the extent to which news analytics has been embraced and adopted by people. It goes to show the extent to which people are trading news analytics because of the fact the immediate extent of the move that we see in the markets after a news article. There are a few more automated news analytics based risk management failures. One was to do with the hacking of the Associated Foreign Press Twitter account. Associated Foreign Press is one of the leading news agencies, and then so people who trade on the basis of news articles, they trust the Twitter account of Associated Foreign Press. So whatever news article is published by Associated Foreign Press, people respond to it and then trade on it automatically. But then one day, someone hacked the Twitter account of Associated Foreign Press. They said that the White House has been bombed. And on reading that news article, automated trading systems they sold the market straight away, so the market dropped 0.8% momentarily, and then it was people realized that it was just a hoax, and then the market rebounded immediately. But then that was another incident. In fact, there is yet another very interesting story that I have heard. I'm not very sure of the accuracy. So, automated trading systems, news analytics-based trading systems were taught that if you see a keyword like Osama bin Laden in the news article, it's probably not a good news article. It probably doesn't mean positive for the equity markets. It probably doesn't mean positive sentiment for the equity markets. Likewise, it was also taught that if in the same article as Osama bin Laden, if you see the word debt, it probably doesn't mean good for the equity markets. Or it was probably taught that if you just see the word debt, it probably doesn't mean very good for the equity markets. So in May 2013, on the 2nd of May 2013, when Osama bin Laden was captured in Abbottabad and then he was killed, so news articles came out, Osama bin Laden killed. Now, all those automated trading systems which were trained that Osama bin Laden is a negative keyword, killed is a negative keyword, thought that it was a hugely negative news article. So they sold the markets immediately after on seeing this news article. But a human being would have responded differently. He would not have sold in the markets on seeing such a news article. So there are risks to automating it. So your automated trading systems would have intelligence only to the extent you have built it within the system. So we have seen around 10 case studies. These are the 10 biggest incidents that have happened with regards to automated trading. So why do these incidents happen? How can you prevent your firm from being on the losing side of such an incident? How can you avoid such scenarios? Well, traditionally, trading operations have focused on the following risks. So when you talk about risk management, people look at risk management in terms of market risks primarily. Then they will look at in terms of counterparty risk or credit risk. They look at liquidity risk, financial risk, and a bit on regulatory risk. But with the advent of automated trading, the focus has changed entirely into operational risk or systems risk. Well, in case of automated trading or algorithmic trading, orders flow out without human control. And then we have seen the architecture of an automated trading system. We've seen how it has become hugely complicated and complex. So because it has become hugely complicated and complex, so we know that the reliance on technology has gone up quite dramatically. Just a minute. So the reliance on technology has gone up, dependence on technology has gone up drastically. And in case of technology, there is this term in software engineering known as GIGO. What does it mean? It means if you feed garbage to the software program, and if it cannot detect that it has been fed something incorrect, if it's not resilient enough, if the system is not robust enough, then it's going to give you a garbage as the output. We have seen that in case of among those 10 incidents, we have seen it in case of all those automated news analytics-based strategies, wherein when it was fed an incorrect news article, be it the case of United Airlines, be it the case of the Associated Foreign Press account hack, be it the case of the death of Osama bin Laden. So on all this, in all these incidents, the moment there was a drop, incorrect input, the output by the trading system was incorrect. Or we could even say the incident with HanMag Securities wherein the input to the system was incorrect. The system thought that those were in the money options, but then in reality they were out of the money instruments with the out of the money instruments, and they were the calls and the puts were interchanged. So when you have incorrect inputs, the outputs are going to be incorrect. The worst part about it is your automated trading system. Now, remember very early on we talked about why people are embracing automated trading. That's because the moment you get an opportunity, your automated trading system will straight away latch onto it and trade on it. In fact, I'm going to give a very interesting anecdote. So I was in Chicago 2 years ago to speak at a conference, and then so there was this FIA event going on. So FIA is the biggest conference on in the futures industry. So that was happening. So one of the automated trading platform vendors wanted to advertise their products. So they said that they installed, they had an iPad. On the iPad, you just had one button. And then the moment the color of the button changed from red to black or black to red, you had to tap on the button. That's it. So across 2 days, or was it 3 days? Across 3 days, the person who could do it the fastest would get to keep the iPad. And then more than 1,000 people played this game. So whoever could tap on the screen fastest would get the iPad. Now more than 1,000 people played this game, and then the fastest that someone did was around 400 milliseconds, if I remember correctly. So when you have only one thing to do, you just have to tap on the screen. And when you had only one thing to monitor for, which is change of the button from red to black, a human action still takes 400 milliseconds. Now, in contrast, in real life, a human eye will have to actually monitor a huge number of stocks, prices, patterns, and so on. And then by the time he realizes that a trading opportunity has occurred, he would then have to type in the name of the instrument on which he is to, so he would respond. How would he respond? He would type in the name of the instrument, the price, the quantity, the type of order, whether it's buy or a sell. And after having typed in all these details, he would cross-check, double-check, verify, and then send out the order. So basically, the response time of a human eye is way higher. And you could only respond to lesser number of opportunities per second. So basically, the fact is that automated computer systems, meanwhile, can respond in microseconds. It can even respond in single-digit microseconds to events in the market. So while an automated trading system can respond in microseconds, a human being takes way longer. Because an automated trading system can respond in microseconds, therefore, if the input is incorrect, every few microseconds it would send out grossly incorrect orders to the market. And before, so a human eye would take probably a few seconds to even realize that something has gone wrong. A few seconds to a few minutes to realize that things have gone wrong. Even at firms like HanMag Capital, GetCo, which was the leader in the field of automated trading, it took them 45 minutes to realize that something was incorrect. And in those 45 minutes, 46 minutes, they lost $60 million. So trades happen at a very fast pace, and then if you set a parameter incorrectly, everyone will trade against you. So your positions will build up really quick. So the challenge is that risk management has to happen in real time. Risk management of positions, exposures, and so on. Everything has to happen in real time. So these are the challenges. Tremendous damage would have done, and positions become huge in no time. So we are going to see that how each and every incident that we have seen that has happened before, those 10 incidents, could have been avoided if the automated trading system was designed in a smart way. So how to design such smart automated trading systems which can handle automated trading related, algorithmic trading related risks. So handling algorithmic trading related risks. So what are the things that you could do? So the algorithmic trading related risks can be categorized into 6 different areas. So these 6 different categories are access, consistency, quality, algorithm, technology, and scalability. I know a lot of you would be having questions as what is access, what is consistency, what is quality. So we are going to look at each of them in detail a little further on. So what type of risks fall under access, what type of risks fall under consistency, and so on. There are 2 places where risk management is handled. So within the architecture of an automated trading system, so this at a very broad level is the architecture of most automated trading systems. So you get data from the exchange, it gets into the market data block. The market data block normalizes the data and then feeds it to the rest of the system. In the complex event processing block, you have all your trading logic, and then it calculates when to send orders and so on. The parameters within complex event processing block actually come from the application block, and the complex event processing block, when it determines that an order has to be sent, informs the order manager that an order has to be sent to the exchange. The order manager generates the packet in the right format and so on. Now there are 2 places where risk management has to be done. One, it's within the application. You have to ensure that wrong parameters are not set by the trader and configured in the CEP. So the trader, so basically say the implied volatility of options, of index options are currently trading at around 20%. The system should not allow the trader to incorrectly enter 200% as the buying parameter for buying implied volatility. Or it should not let the trader incorrectly set 2.1 instead of 20.1 as the selling price. So if the current value is 20, it should not let you set grossly incorrect value. So those type of errors are known as fat finger risk errors. Fat finger errors are basically typos, wherein you type in an incorrect parameter. The reason they are all fat finger errors are because if you say have a very fat finger while typing on the keyboard, your finger might hit another key and then you might end up doing a typing error. So fat finger risk management checks are handled within the application, which ensure that you don't end up entering a wrong parameter. But that is not all. Ensuring that you don't enter a wrong parameter is just 10% of the risk management. So what you need to do is, at the end of the day, all said and done, everything being done, you need to ensure that eventually, before the order flows out of the system, it goes through some risk management checks. So this is where the most critical risk management checks happen. Sorry. This is where the most critical risk management checks happen. So things like what is the value of the order? Are we trying to send an order with a value of a few $1 million or so? And then we know that if you send such an order in the equity markets, it's definitely going to move the markets drastically. So a lot of these checks are handled here. So we are going to look at them now. So remember, I talked about 6 broad categories of algorithmic trading related risks. So we are going to look at the 6 broad categories of algorithmic trading related risks. So the first is access. What is access? Say you have a trading strategy which trades in 2 different exchanges. It takes the price of an instrument trading in exchange 1 and then trades it in exchange 2. Remember the incident that happened at Deutsche Bank wherein they had to close down their ATQ desk in Tokyo? they use the prices of Nikkei in Singapore to trade in Nikkei in Tokyo and vice versa. Now, if the connectivity to an exchange is down, in that case, the input would be incorrect. In case of Deutsche Bank, it was still pretty straightforward because they just didn't get any data at all. So when you don't see any data at all, it's still easy. But then if it goes down in the middle of the day, how do you determine that you have the latest price? For example, you could be trading ST Microsystems in Euronext Paris, in Borsa Italiana, in CAEX, in PADS, in NASDAQ. Now say suddenly the price feed of ST Microsystems, your connectivity to Borsa Italiana goes down. That is the prime exchange. That along with Euronext Paris is the prime exchange where ST Microsystems is traded. Now, because the connectivity has gone down, you have no idea what is the latest price. And therefore, you will keep quoting on the other exchanges at something you're trading in the other exchanges based on an old value. So how do you handle against that? There is this concept known as hard bits within with the exchanges. You might not be seeing data from the exchanges for a long time because genuinely there will be no activity in the exchange. Because genuinely there is no activity, you might not be seeing anything. So for a minute, you might not be seeing any market data at all on a particular instrument or whatever because there is no activity. So how do you know that you are not seeing data because there is no activity or because your connectivity is down? There is a type of message known as heartbeat message. You can send a heartbeat message to the exchange. The moment the exchange gets a heartbeat message from you, it responds back to you, so that you know that you are actually connected to the exchange. So you could do that. You could use heartbeat exchange to check your connectivity to the exchange. Access is also critical. Say once again you're trading ST Microsystems in Borsa Italiana versus ST Microsystems in Euronext Paris. Now suddenly your connectivity to Euronext Paris has gone down. So while you keep buying ST Microsystems in Borsa Italiana, the corresponding hedge which was selling ST Microsystem in Euronext Paris, you can't do it anymore. So you'll keep accumulating a huge position in one exchange and then you will not be able to offset it in the other exchange. So even in such cases of smart order routing based strategies wherein you're trading the differential between two exchanges, you need to ensure that you're connected, that you don't keep on doing trades in one exchange when you are disconnected from the other exchange. Not just that, you might have incorrect data because the market data is stale. What is stale market data? So now we have come into this segment on consistency. So you might be connected to both the exchanges, but then, or it might be a single exchange strategy. You might be connected to the exchange and then you might be getting data, but then the data might be stale. What does stale data means? I remember when some of those exchanges started providing granular data. So tick by tick started moving from snapshot-based data to tick-by-tick data. So in snapshot-based data, the exchange just provides you a snapshot of the top 5 or top 10 or top 15 best buyers or best sellers in the exchange. In case of tick-by-tick, the exchange actually provides you each and every tick that happens on the exchange immediately. So the amount of data that you have in tick-by-tick data is way higher than the amount of data that you have in snapshot-based data. So I remember incidents where exchanges which had just moved from snapshot to tick-by-tick data, they probably didn't fathom the huge amount of volume that they would have in tick-by-tick data. So the tick-by-tick data feed was actually significantly slower, delayed, because the exchange didn't have the infrastructure to handle such a huge volume of activity, and then therefore you could have information which is hugely delayed. So if your trading system uses, your trading system would use market data as an input in the system, But if the market data itself is delayed, is stale, then you are feeding in garbage to the system. And then if you feed in garbage to the system, we've already seen the output is going to be garbage. So, if you are feeding in stale data, your output is going to be incorrect, and then you are going to lose money. So that is what is going to happen. So how do you protect against yourself against that? So market data packets would have a timestamp in the packet. In fact, these days most advanced exchanges globally, what they are adopting concepts like time syncs to atomic clocks. What does that mean? So basically, you can sync your the time in your trading servers to the time in the exchange server, so that you know what is precisely the exact time in the exchange server right now. So you can do it up to an accuracy of microseconds, and then so you know that what is the time that the exchange server is, what is the exact time at the exchange server right now, precisely to microseconds. Now, because you can do that, and then because market data packets would have a timestamp, if you get a market data from the exchange where the timestamp is usually different from the current timestamp of your server, you know that your information is delayed. So if you see the data where the timestamp of the packet is hugely different from the, how do I remove this? It's not just that. Often you need to ensure, this thing has come in between. Often you need to also ensure that your analytics are running in real time. What does that mean? What does that mean? Say there is a lot of load on your trading server. Say you are doing tens and hundreds of the other calculations in the trading server in addition to your strategy. In that case, you might not be able to see data in your trading strategy might not be running in real time. Say you just have 4 cores in your trading server, or even say you have 32 cores in your trading server. But then if you have 50 different processes, 50 different applications running at that point of time, your trading strategy might not get a core in real time to process that data in real time. Because it might not get the CPU core straight away, it might be responding very late to events happening in the market. So while I wouldn't call that a risk per se, but then you are going to do a lot of erroneous trades because your calculations are not happening in real time. You are not allocating your hardware efficiently, and then therefore your software is running inefficiently, your analytics are running hugely delayed, and so on. Likewise, it could happen in case of the order manager adapter itself. So any of those software blocks within this system, if it's delayed, if it's running here grossly slowly, then the output is never going to be correct. The next thing is quality. What is quality? You need to ensure that the input is correct. Only that the output would be correct. Remember, in case of Nikkei, in case of Deutsche Bank in Tokyo, Nikkei versus mini Nikkei versus Nikkei ETF, the input was incorrect. The input was 0. So they were trying to sell mini Nikkei at 0 plus a small offset. So you need to ensure that your input is correct. So market data is garbage. I have seen in some weird cases snapshot data wherein the bid was higher than the ask, which cannot happen actually. Or I remember when I used to be an So I remember when I used to be a primary market maker in the options market in Europe. So just prior to an economic release, the market would vanish for a lot of those instruments. The market would become hugely illiquid. So if your trading strategy uses the price of instrument A to price instrument B, now if because of illiquidity the prices in A, the market in A has become illiquid. Now because of high volatility, the market in A has become illiquid, and therefore the prices in A are so illiquid. Because the prices in A are illiquid, your trading strategy which trades in instrument B on the basis of prices in instrument A would be trading on random illiquid prices. If the fair valuation, so for example, if the fair valuation of A is 100, and based on the price of 100 in A, you are supposed to send an order at a price of 200 in B. Okay. So if fair valuation of A is 100, you are supposed to send an order at 200 in B. But just prior to an economic release, or just say the central bank rate decision, or quarterly earnings announcement, or whatever, there is high volatility and A has become illiquid. So the bid in A has become 50, and then the ask in A has become 175. So because the bid and the ask in A has become hugely wide, how do you know what is the fair price of A? So because you cannot determine the fair price of A, how can you determine what is the price at which you should trade in B? So therefore, what you need to do is you need to ensure that at the moment of liquidity, at the moment of illiquidity, your strategy automatically realizes that it should not keep trading. So all along, what I've done is, remember a little early on, I mentioned that you could handle risk management at two places, either within the application or in the order manager. So I've tried to highlight which of those risk management requirements you need to handle in which location. So by app, I mean app plus CEP actually. Okay. The fourth category is actually the most interesting category, because this is where most of your automated trading based errors happen. And basically, if you have a small coding error, so what would happen is that it would reflect in terms of incorrect execution in the market. So some of the things are like risk limits exceeded. Why would that happen? Because you do not check for acknowledgement before sending an order. So you've sent an order, even before the acknowledgement for that order has come, you sent out another order, and suddenly both of them get executed. So while you wanted to have only one execution, because you didn't wait for the acknowledgement and then you keep sending orders, that could happen. Now, if you have an incorrect strategy setting, so the trader is supposed to buy within a range of 20 to 25, but then he enters a value of 205 incorrectly. So what would happen if he sets such an incorrect parameter? He's going to do a lot of trades. A lot of orders are going to flow out of the system. So you could have a thing like order throttle rate in the order manager. Within the order manager, what it will do is it will say that if I'm sending out a huge number of orders, then I know that if I'm doing something right, I have to compete with everyone to make money. But if I'm doing something wrong, then I'm going to do a lot of trades. It's not easy to do a lot of good trades very quickly, but it's very easy to do a lot of bad trades very quickly. So if I'm sending out a lot of orders, it means that possibly I am doing something wrong. So within the OM, if I'm sending out a lot of orders, check that. I already mentioned that within the app, you could check your fat finger settings saying that, okay, only values between 20 to 25 should be allowed. You could have a max value traded saying that, okay, if I'm doing a lot of trades. One thing which always catches errors, which I find very good, is the P&L based risk management check. All said and done, if your mark to market prices based P&L drops a lot, it means that there is something wrong. So of your portfolio, if your P&L has dropped drastically suddenly, it means that there is something wrong going on in your system. So I recommend everyone to have P&L based risk management checks, wherein the moment the P&L of your system drops by more than X, the automated trading system should automatically stop doing anything in the markets. So that is one more thing that I suggest to everyone. In addition to things like order throttle rate, which says that if I'm sending out a lot of orders, it means something wrong, and so on. Incorrect order generation. So what you could do is you could actually look at the price range. So if the last traded price or the last bid and ask was X, Y, then I shouldn't be sending an order which is at least 100% away from that price, and so on. The fifth category is technology. Some of these might seem a bit comical, but it actually does happen. Remember the case of Knight Capital? It was a protocol mismatch. They had to install modules A and module A and module B in all the 8 trading servers. On one of those servers, they only installed module A, and then module B was not installed, so it was a protocol mismatch. So that is something that could happen. In case of Knight Capital, it was very evident because they had to install module A and module B on all servers. But it could also happen that you are installing some other independent server and then application, and that has a dependency. You are installing an application, and then the application has a dependency that you need to have certain libraries in your system. So if it doesn't, there could be those indirect dependencies as well. Hard disk gets full. It might seem comical, but then in case of high frequency, you send out a lot of orders to the exchange. You send out a lot of the amount of market data is used, and so on. So if you, for diagnostic purposes, if you do a complete logging, the amount of just the market data in binary format is a few gigabytes. And then if you are doing a diagnostic, if you write that information, it could be a few tens of GBs. And then a lot of those trading firms, if they need faster systems, what they do is they use solid state drives instead of all those old traditional head and the rotating head and pin type of drives. Because solid state drives are expensive, you don't have a huge amount of space in such drives. So it might seem comical, but then monitoring your hard disk usage in real time is critical, because if you're out of disk space, all your systems are going to crash. Now this is another thing where a lot of people fail. So this is the scalability type of risk management errors. So what happens when people design automated trading systems? What they do is they say, okay, the quality check guy, what they will do is they will test it with one instrument, one scenario, and they'll say that, okay, it has worked fine, and then this is great. It works well in one instrument, and then I think we can take it to. But what they would do is they would test it with one instrument for all scenarios. So it works well in all scenarios just for one instrument. But then when you go from one instrument to 10 instruments, does it still work well? So let me introduce you to a concept known as order of complexity of computations from theory of computation. So there is this concept known as order of complexity. Oh, this is not. The pen is not working. So there is this concept. Let me use the mouse itself. I don't know. I don't know how to switch this on. Oh, Priya, this is not working, or do I need to switch it on somewhere? Okay, I'll use the mouse. Okay. Oh, lovely. Thank you. So there is this concept known as the order of complexity. So what does it mean? Yeah. So basically, each piece of code, you can say what is the maximum order of complexity of the code. So if there is a piece of code wherein everything is done serially, all instructions are executed serially one after another, then the order of complexity is order of n. But within the code, if you have a code which is executed in a loop, so you could say that for each instrument, for I is equal to 1 to total number of instruments n, I'm going to do a particular calculation. Say, for example, you have to sort, or you have to find out the maximum in the range. So for each and every instrument, you have to find out, you have to do this loop, because you need to find out the value for each instrument, and then from that you are going to derive the maximum. So for this, straight throw is an order of 1. This is order of n, or the order of complexity is order of n square, and then you could have 2 loops for I is equal to 1 to n. So for finding the max, you just need to run the loop once, right? For finding for sorting, you need to run the loop twice. And so on. So in the first loop, you will find out the maximum. In the second loop, you will find the second highest. The third loop, you will find the third highest, and so on. So you would need to run it 2 loops. But the order of complexity will be order of n squared. So say, oh sorry, this would have order of n. This would be order of n square and cube and so on. So because for every n instrument, the time will be a linear function of time. So if you tested the system, so you could have order of n to the power 4 and so on. So if you tested the system with 1 instrument, for doing 1, it takes 1. For doing a program complexity n squared with 1 instrument, the time taken is still 1. N cubed, the time taken is still 1. N to the power 4, the time taken is still 1. But if you suddenly try to trade this using 100 instruments, order of n, this is still 100, but this is 100 square, 10,000. 1 million. 100 million. So what? Say your entire flow takes a few tens of microseconds. When you test it with 1 instrument, irrespective of the complexity of the logic, you will still take 10 microseconds. But if the order of complexity is n to the power 4, you are going to take 1 billion microseconds. So while you might have tested the system for all scenarios using just 1 instrument, but then when you scale it up, when you increase the number of instruments that you are trading, when you increase the number of exchanges that you are trading, when you increase the number of portfolios that you are trading, it might not be able to work. So another example. So when you go from 1 to 100 instruments, now say each instrument was dedicated 1 CPU core, And then, but then your hardware, your CPU only has say 32 or 64 cores. 64 core server is pretty expensive by the way. So say you have a 32 core CPU, and then you tested it for one instrument and then that was fine. But then when you go try to trade more than 32 instruments, there aren't cores to allocate for, dedicated cores to allocate for it, and then there would be clashing and so on, and your system would not perform well. So that is another risk that you have. So by and large, so if you handle these 6 categories of risks, you would see that all these 10 risk management failures would not have happened. Well, it's difficult for cases wherein new automated news-based trading is a bit difficult because of what happens when the Twitter account is hacked. Even human beings reading those news articles, the Twitter feed would respond in the same way. But the rest of those incidents that we have seen, the rest of the 8 incidents that we've seen, HanMag Securities, Everbright, Goldman Sachs, Knight Capital, Deutsche Bank, Infinium, Credit Suisse, all of them could have been prevented by using one or the other of those 6 categories of risk checks. In fact, you could add one more of those. Confirmation before setting any strategy parameter is another thing that you could add. Well, this was not designed to be initially part of today's webinar. I'm just adding another segment very quickly because I think this might be interesting. So say, what is the typical life cycle of design of a trading strategy? What is the typical life cycle of design of a trading strategy? You have someone who has expertise in the markets, so he would make a, so someone who knows how prices change in the market, someone who's been in the markets for a long time, who observes the market, and then he says that, okay, from what I observe, I think event A leads to event B. So whenever event A happens in the market, I think event B follows. So that is a hypothesis. Once the hypothesis is done, what do you do next? So you try to validate the hypothesis. You try to see if the hypothesis is really true. If so, how do you validate if the hypothesis is really true? You do backtesting against I would rather use the term validation. Against historical data. What is the third step? So basically someone makes a hypothesis. Once the hypothesis is just a hypothesis, it could be correct, it could be wrong. So you need to validate the hypothesis. How do you validate it? You validate it against historical data by running statistical tests. What is the next step? Once the hypothesis is proven to be true, if it is proven to be false, then okay, that's the end. Here you again go back to step 1. So if it's proven to be true, the next step is, okay, you code it on an algorithmic trading platform. Once you code it on an algorithmic trading platform, what do you do next? Do you trade it on the exchange? Well, it's possible that this hypothesis was done by someone who has experience in the market, who knows how the prices change. So it was done by a trader. Coding on an algorithmic trading platform was done by a software developer. These are 2 different people. There could be communication mismatches. So what do you do? So do you directly trade on the exchange? No, you don't do that. So you trade on simulator. What is a simulator? So instead of sending orders to the exchange, what you do is you send orders to a piece of software known as a simulator. The simulator tries to behave in the same way as the exchange would have. So if you send a buy order at a price higher than the best ask, then it would get filled in the market if the quantity is available. So a simulator tries to simulate the behavior of the rest of the market in the exchange. So instead of sending orders to the real market, you send orders to the simulator. Once it is fine, then you trade on the live, go live. So basically, when you trade on the simulator, there are two things that happen. One, the software developer might have implemented incorrectly, functional mismatch. The trader might have said the buy when the event occurs, and then the software programmer might have programmed it to sell. So there is a functional mismatch that could have happened. Two, there are technological issues. So that those of you who are from a background in computer engineering would realize that if you try to divide something by zero, then you don't, it's an undefined number. So your system could crash if it's not handled properly. So there could be technological issues. So there could be functional mismatches, there could be technological issues, because there could be both, either of them. So you don't go live directly, you trade on simulator. Not just that, most automated trading systems, what they do is they give you an ability, a lot of them give you an ability to replay historical data. So that once the system is designed, you can replay historical data and then trade your system against historical data. So you could either wait for trading hours to test against simulator, or you could do it against historical data which is replayed. So you could replay historical data. So what happens in that case? Well, it actually gives you the flexibility to see how your system would have responded on a day on which the market was hugely volatile, on a day on which the market was just grossly one-directional, on a day on which the market just was very quiet, on a day on which the market was hugely volatile, and so on. So you can actually test your system against various types of scenarios. On a day when the market was very liquid, volatile followed by liquid, or a day where the number of ticks was huge. So you need to see whether your system could actually handle such complexity. There is another scalability related issue that I remember. So if your operating system is 32-bit, total addressable memory space of such an in that operating system is 2 to the power 32 minus 1, which is 3 GB. So if your real-time memory usage is more than 3 gigabytes, then your system might not work anymore. So that is another scalability related issue that you could have. So any questions till this point of time? Someone said, do you think at this point of time there is a problem of pricing power for market maker? So that is unrelated to risk management, right? What do you mean by problem of pricing power for market maker? Well, there is a problem because you are mostly follower rather than okay. Oh, so the question was related to at the point of economic release, at the point of central bank rate decisions, at the point of quarterly releases, the markets become illiquid, and therefore, is there a problem of pricing power for market maker? Yes, definitely, because if the underlying, so basically you use an instrument X to price on other instruments. That is how the market maker has to derive his fair valuation of the price. So because of illiquidity, so you cannot use the price of X to trade on other instruments. So therefore, there is a problem of pricing power for the market maker. Okay. So the one participant asked, what will be the best way of identifying and managing positions? Well, that is market risks. You are talking about how do we handle market risks. So portfolio management is a entirely vast topic in itself, and then we have a dedicated segment on portfolio management. So wherein we look at sorry, what is this? Okay. So wherein we look at first, how do you determine which strategies you should be trading in the first place? Once you have determined which strategies you should be trading in by studying the profitability of various strategies, how do you determine how much money to put in each strategy? The next is, after you have determined how much money to put in each strategy, how do you determine how much money to put in each trade? So we do all of those in detail. So that is beyond the scope of today's quick webinar. Someone said, ask, can we get a recording of this webinar? Obviously, definitely, sure. The question was managing position in case of server crash and all those things. How do I ensure business continuity? Business continuity. Okay. So most exchanges have this concept of drop copy and so on. So copy of your positions always exist at the broker and so on. So you could use that copy to generate your positions and then therefore generate your risks, and then quickly so you can always send orders very quickly through the admin terminals and so on, and then basically you need to build the infrastructure and to be able to get your positions on your system, and then you could get the positions there as well. Okay. One more thing, like some people use this one more. So there's a question, I didn't get the exact question. So one more thing, like some people uses one market's information to trade in another market. Do you think in that process there is a functional difference? Can you please elaborate your question? Okay, there is one more question. What is prospect of algorithmic trading in India? Okay, so if you ask me, algorithmic trading in India was basically direct market access was opened up in 2008, and then very quickly a lot of people started working on it, and then a lot of global firms entered into India. The growth in volumes has been tremendous, and then so a lot of earlier illiquid asset classes became liquid purely because of algorithmic trading and high frequency trading and so on. So it has been hugely positive for the market. A lot of those risk checks we have if you may ask me, I think we have the most stringent algo trading risk-related regulatory environment globally, and then so we haven't had many cases like the rest of the examples. In fact, some of those incidents cannot happen in India. So for the thing that happened in case of the first example, Credit Suisse, the exchange just locked down. It couldn't handle such a huge volume of information. That couldn't happen because in India you have a order total rate which the various exchanges manage themselves, so that you cannot send huge number of orders to the exchange and so on. So you need to actually get your strategies approved by the exchange. You need to get your network, the actual infrastructure architecture approved by the exchange. You need to get your strategy approved by the exchange. You need to demonstrate that it works well with regards to the various risk management checks. So you need to actually demonstrate that each of those risk management checks is handled in the system and so on. So algo trading has grown a lot, and then it has helped make a lot of these instruments liquid. So for example, the growth in volumes in the option segment, in equity options, in or even in the currency segment, or so everything has to do with the algorithmic trading. So someone asked, can algorithmic trading help retail traders? Well, it definitely helps. One, it makes markets more liquid. So without algorithmic trading, a lot of instruments would be hugely illiquid, number one. Number two, the bid-ask spread reduces drastically because of algorithmic trading. So the price discovery is much more efficient with algorithmic trading. So there was a report by IT Group which does a lot of research on market structures, and then they published how algorithmic trading, how it has helped retail traders. The reduction in bid-ask spread alone contributes to $500 a year for retail investors. That is what it says. I found the term $500 hard to believe, but then that is what their research says. Big investors in the market, retail investors, they benefit as much as $500 a year just on reduced bid-ask spread, and obviously it helps reduce volatility in the market. Rikesh? So Pramit asks a question. Let's say one person trading Nikkei in Hong Kong and Italian simultaneously. Let's say some lag in getting information from. I still didn't get this question. So it says someone trading Nikkei in Hong Kong and Italian simultaneously. Let's say some lag in getting information from one market to another. In that way, is there any functional difference? No, I still didn't get that question. Okay, there is this detailed question on request to share an example about Indian markets with any example. How is bond market usage to algo trading and what level globally and so on. So basically, the usage of algorithmic trading in India is still nascent, and then while we are using the most sophisticated technologies in India and so on, but then because of high transaction costs and then high taxes and so on, securities transaction tax and so on, the volumes are not as high and so on. So as compared to globally. Okay. So let us look at some of the regulatory aspects of it. I see that we have a lot of participants from South Asia, we have a lot of Southeast Asia, from Europe, and then a few from the US as well. So, but the example that I'm giving is from India, because which I think has the one of the most stringent regulatory environments. So this, and then most of the participants, a lot of the participants are from India. So in India, you need to get your strategies approved by the exchange. Yeah, so what you need to do, you also need to do a half-yearly audit and an annual audit. Audit by the regulator, by the exchange, by independent auditors. And basically, once you design a quantitative automated trading strategy, you need to trade it in an exchange, in the exchange test environment. You need to test it in a mock trading environment, which is mandatory for everyone to participate. So on the mock trading environment, the amount of volume is huge. So you need to test your algorithm against the mock trading environment. Once you have done that, you need to apply for to the exchange for approval, and then you have to provide the following documents. So once you do that, you need to demonstrate your exchange strategy to the exchange. So when you demonstrate your strategy to the exchange, these are generally the risk management checks that you have to demonstrate to the exchange that your system is working fine. So once you demonstrate that your system handles these risk management checks, you are authorized and allowed to start trading on the exchange. So these are some of the things that you need to do. So whether you actually have shares in the system before you can start trading. The automated trading enable check. So basically, the administrator should be able to specify that you can only trade in a certain set of instruments. Remember what happened in case of Infinium Capital? The system was supposed to use prices of crude oil and trade in the ETF, but then the trader started doing it the other way around. So your automated trading system should be enabled for the select set of instruments only. So the administrator should be able to say that, okay, you can use this only to trade on ETFs using crude as the base. It should not be the other way around. So the price range, so order should not go or bridge the daily circuit limit. For each instrument, an order size freeze has been specified, so you cannot send orders greater than a particular size. You cannot build up a position bigger than a particular level. You cannot send orders in such a way that if that order gets executed, the total margin usage of your account will be greater than 90% of the amount that you have in your account, and so on. The max order value, the net position value per instrument. So all these things have to be demonstrated to the exchange. So once you do it, once the strategy gets approved, you start trading with strategy. But then you need to keep a log of all activities that you have done for the past 5 years. In case of Hong Kong, it's 2 years. In case of Germany, I think it was 4 years. So you need to keep doing those activities. Yeah, someone asked, is there an approval required for starting algo trading in National Stock Exchange in India? Yeah, you need to. Okay, so I felt that the last segment would be very might not be as interesting for a lot of you, so I just quickly ran through it, and then because I just used a case study of the Indian markets. So okay, so very quickly I'll give you a very quick background of our algorithmic trading education program. So the course is divided into 3 segments. The first part is the building blocks, which is statistics and econometrics. So the first part is the building block. The second part is, so you here start from basic statistics, go all the way to advanced statistics, do things like time series analysis and so on. The second part, so once you've understood the building blocks, what do you do next? You also need to know how other people globally design their trading strategies. You need to, so just knowing the building blocks is not good enough. You need to also know how people actually trade, or what are the strategies that people are already trading. So to give you an insight into various type of trading strategies, that is what is handled in the second segment. So that is it. So once you've seen how other people have built trading strategies, that would give you insights and inspiration to design something of your own. So you could use concepts used by other people, so to design your trading strategies. Once you've designed it, obviously you'd want to do it as well as scale it up as much as possible and so on. So that is where the third segment comes into the picture, the financial computing and technology. So you would be working on an algorithmic trading platform, you would be working with simulators, you would be working against how to replay historical data and so on. You would be working on big data analytical tools like R. So basically R is the flavor of the season right now for working on huge amounts of historical data for statistical analysis. So R, it's an open source tool, so that's a good thing. Once you learn it for in a course here, you could actually download R and then do all those studies on your own at home, and you don't need to pay for a license. So, and then you, at the end of the 4 months of classes, so the classes are held 2 times a week on Saturdays and Sundays, 3 hours every Saturday and 3 hours on Sunday. So at the end of every 1.5 months, you get a break of 1 week so that you can revise and then collate all your revise and so on. Get time to rebrush on topics. And then at the end of the 4 months of classes, you get to do a project work. So in the project work, you actually get into the detail of a particular topic and then work on it in depth, and then we would help you hopefully write a project paper which gets published anywhere. And yeah, so basically for any doubts and queries, you can contact us any point of time. We understand the course content is quite huge. In fact, we have added a few modules lately with, from external partners. So basically some of those exchanges, Bursa Malaysia and hopefully CME, they would be conducting some additional modules within this segment, introducing international course participants about the various products available on the exchanges, and then what are the common strategies that traders trade on those exchanges, what are the correlations among various products and so on. We have other external participants. We have Mr. Radhakrishna from Goldman Sachs talking about the emergence of ETFs, opportunities in ETFs and so on. So basically the amount of course content we understand is huge. So often a lot of participants, they feel that they need more time and so on. So once you become a student, you're a student for life. So you can redo some of those classes in the next batch. You could do the first module with the first batch and then take a break and then revise the first module in depth and then rejoin with the second batch and then do the second module and so on. So I have had one student who did the same class for with 3 batches because he wanted to. It was a very complex class, and then he did it for 3 batches, with 3 batches. So that is also possible. You just have to pay once. You don't have to pay again and again because you are rejoining with another batch. So that's how it is. Okay. So any more questions, guys and girls? Any recognition of the course? Oh, that's interesting. A few days back, I actually saw an advertisement in a recruitment website saying that any degree, for example, the degree by QuantInsti would be good to have. So we have a placement cell wherein we talk with corporates and then help our students get placed. So we have had quite a few students we have helped place in the industry, and then the degree recognition. I think at least when I've seen people mentioning that in the internet, I think there is a recognition, because at least we are recognized by various exchanges and associations internationally who call us for. So we have done workshops for the Stock Exchange of Thailand. We did for Thailand Futures Exchange. We did workshops with Bursa Malaysia and then SGX. And then obviously we have done quite a few sessions for National Stock Exchange in India. So and then we did conducted events with Goldman Sachs. We did one with Thomson Reuters. So there is a lot of recognition per se, and we've been invited to a lot of global events and so on. So someone asked, as I'm in office, non-related question, how is it related to CCRA? I'm not sure how it is related to CCRA. What is CCRA? It's the AIWI thing? Okay. I'm not purely cognizant how CCRA comes. I think they also offer some sort of certifications and so on, but then we are not offering our certification through CCRA right now. Okay, any more questions? Yeah, so someone from AIWMI actually came to us, and then I think it's based in Switzerland or something, right? And then they came to us and then said that they would be keen to probably host our certification under their umbrella and so on. But no, we are not affiliated with them or anything. We are not related to them. What is this last question? Well, someone asked any validation of the course for long run. Well, if you ask me, the best investment that anyone can do personally is an investment on one's own skills. Skill development is the best investment that one can do, and then the best way to improve one's skills, one can try doing it on its own, or one can use the help of experts who have been working on their respective subdomains to get dedicated education on subtopics. So if you ask me, I personally miss, if you want to get into algorithmic trading, if you want to, because it's a hugely complex domain, as we have already seen, so you could end up doing a lot of those risk management errors as well. So you need to have a good understanding of the building blocks. So to be able to do that, you need a good dedicated education of the concepts. So to be able to do that, you need a course like this. Definitely helps. Either a course like this, or you can, if you can find independent resources on the internet. But then, yeah, a lot of people I know, I can actually cite incident examples on the tip of my hand. People who have been able to make significant career jumps immediately after the course because of the awareness and of various concepts that they could make after the course. Someone said, can we get a recording of the webinar? Yeah, definitely, for sure. Okay, someone asked, do you have to be an expert in programming to attend the course? Well, a lot of people who attend the course are not are mid-level managers or even senior level managers as well. So not all of them are looking at programming their automated trading strategy on a platform per se directly. What they are looking at is the ability to understand the complexity of the whole process. What are the so basically a middle level manager, he would want to get a feel of how is it to work on an algorithmic trading platform. So he might not be good in programming, but then we give them the primers on programming, and then so basically we want to make everyone get a feel of the complexity of the entire process. So that when you're managing a team of traders, you know that okay, how much time should it take to write a simple arbitrage strategies? How much time should it take? What are the complexities? Where are the places where it could go wrong? Where are places where it could fail? So to be able to understand and appreciate them, you need to get a bit of hands-on experience. But then, yeah, we don't expect people to be experts in programming. In fact, because most of our participants are middle level career professionals, so a lot of them are not that conversant with programming, or a lot of them had done programming long ago and are not that that much in touch with programming anymore. So no, that is not a prerequisite for the course. Well, because programming is just one part of it, right? So we talked about the 3 segments. So the first segment was statistics, basic to advanced. The second segment was various quantitative trading strategies for various asset classes, various holding periods, various styles of trading. So neither of those 2 segments require programming. The third segment, if you again remember, statistical tools, R, etc. So these are the new ball games altogether. So prior experience in coding is not required per se. So it's definitely good to be able to program. How much time it takes to complete the project ideally? So the answer to that would be, while we see that we say that it would take 2 months, but then to be very frank, it takes more than 2 months for everyone. So a lot of our participants are already working professionals, so they have to juggle their work and then the project. So we have had people who have taken 7-8 months as well, and then 3-4 months to 7-8 months. The people who have taken 7-8 months have actually done very good jobs because they've been working on it. Some of them have done really in-depth, nice studies. Actually, one of them could actually become a very nicely published paper shortly. And yeah, we have had cases of people actually successfully implementing some of the strategies and recovering multiples of the fees straight away. Okay, any more questions? In project, what exactly is being done? So basically, remember we talked about the second segment wherein you get insights into various kind of trading strategies. So you just get an insight into it, but then to getting into it in depth, looking at it in details, so you would do that in those projects. So okay, any more questions? To give an indication of the kind of projects, for example, a kind of one example of a project would be the relationship between the skew versus the or say the relationship between the skew in one exchange one index versus the skew in another index. The option volatility implied volatility skew. So let's say whether the causality between them, what's the time frame of the causality? Should it be microseconds, milliseconds, seconds, few seconds, minutes, hours, days? So you have to do a lot of statistical analysis, and then once you do the statistical analysis, the next thing that you need to do is you need to once you determine what are the relevant factors, then you have to build a trading strategy after the statistical validation is done. So you need to decide how to build positions, how to determine position sizing, how do you do your hedges, how do you when to trade, and so on. And then once you do that, then you do your paper trading on the basis of the same on historical data and so on. And then participants who got a good hang of the platform, they would also implement their project on an automated trading system and then trade it against the simulator, against historical data, and so on. Okay, any more questions? Oh yeah, tell me. Statistics is definitely important because the question was, is statistics important? It's definitely important because it's a building block, and then basically to be able to make decisions objectively, the decision has to be based on numbers, and then when numbers come into the picture, it's based on statistics. So therefore, we understand that not a lot of participants are not using statistics. Concepts of statistics daily in their day-to-day work. So what we do is we have a primer, so it starts from basic statistics, then moves on to advanced statistics, and then yeah. Okay.
So I have been bypassing the stats because I did HanMag college, but never actually bothered to do stats in trading part.
Okay.
Other than using it every year.
Okay. Okay. So the thing is, yeah. So we therefore the statistics part of it, we realize that some people might be rusty with some of those concepts. So we start from the basics once again. So that the linkage when we go to the advanced concepts could be made. In fact, the statistics segment of the course has gone through a lot of evolutions. So basically, one way in which you could teach is you could probably just keep teaching theoretical concepts, but then that would not be interesting. So how does each concept linked to a particular practical implementation? How does it link to a concept in trading? Why are we learning a particular theoretical concept in of statistics? Where does it apply to in trading? So it has gone through a lot of iterations to be. We have tried to make it very practical oriented, because otherwise you can learn statistics in a maths class as well. But then why are we learning a particular concept? How does it relate to a trading example? So that is what we have tried to do. Okay, so someone has a question. Which other languages other than C++ will be taught? Well, for statistical analysis, you would need to work on R. So you would be taught R, and then you would also, a lot of people for simplified tasks would use Excel and VBA for automation and so on. So we would touch upon that as well. Any more questions? Okay. So there is a question, I'm a personal individual trader. How will this course help me in my personal trading? Okay, so if you look at it globally, the average lifespan of a trader amongst the universe of all the traders is less than a month. The average lifespan of amongst all the traders, if you divide the amount of time that they end up trading by the number of traders, the average span is just less than a month, a few weeks. And yet you have such a huge number of people trading in the markets. Why is that so? And then they are not trading profitably. Why is there a significant mismatch? A huge number of people trading in the markets, yet people say that the average lifespan is just less than a month. The mismatch is because of the fact that not everyone looks at things in a very structured, organized way. If you don't do trading in a structured, organized, or scientific way, you would not succeed in the long run. You have to have a method, you have to have a structure to it. And then therefore people who use structure and method and do it objectively, they sustain in the long run. Now how do you do it in a structured manner? Even if you're doing it individually, how do you do it in a structured manner? To be able to do it in a structured manner, you would need to understand concepts of statistics so that you could quantify your processes, quantify your methodologies. Two, even if you're trading individually, the third segment, introduction to various trading strategies, various trading strategies for various asset classes, trading strategies for various holding periods, for a variety of styles. That would help you get insights into what are the things others are doing and what you could do too. For example, what is the percentage of orders that you send to the exchange that get traded? Any guesses that you would want to make? 45%? No. It would obviously depend on exchange to exchange, product to product, but then it's less than 1%. Well, at NSE in India, it's 0.3%. And that is a figure which I remember the former CTO, the current CTO made 2 years ago. So I don't know what is the correct number today. So most trading strategies look at just the trading prices, last traded prices. But then there is a huge amount of information in the order book. 99.7% of orders that were placed never get traded. But then this 99.7% of orders were put in the market because people had a pressing need to buy or a pressing need to sell. Because there was a pressing need to buy or a pressing need to sell, therefore they put the orders. They didn't put the orders for fun. But then these didn't get traded. So people who just use trading prices, they miss out on 99.7% of the information. So therefore, how to look at order book based dynamics for making trading strategies. That's a hugely popular class, for example. So how do you use second, third, fourth, fifth order Greeks? That's interesting. Okay, so any more questions? Okay, I guess we can call it a day here. It's almost close to, I think it's more than almost 2 hours now. So thanks a lot everyone for your patience. Thanks a lot everyone for your time, for your wonderful interaction, and I hope it was actually as interesting for you guys as it was for us in designing this presentation and in hosting it. So I hope it was just as fun and informative and useful as it was for us in designing it. So it was nice talking to all of you, and then the interaction was interesting. Have a great day, everyone.